we had a really good half, and I mean, I guess the three takeaways from our results are we're getting really strong organic growth, number one. Number two, cash flow is good, and it was really good, and we expect it to continue. But three, the forwards look really good because the model's working. We're really starting to win regional and global business. We're starting to get an uptick in productivity across the group as we expected. We're starting to get buying power as expected. So we see this sort of really nice 3 to 5 year outlook in terms of ticking up margins because as we're getting that scale, it's coming through. So if I go around the results, firstly, Australia, again, as you can appreciate, really tough backdrop in corporate, but we're winning a lot of business. We had a record EBITDA margin, which again just demonstrates what can happen once we get a business integrated, we get the scale right, and we start optimising the business, particularly internal automation. In a nutshell around the world too, we're winning business because of our technology, and we're retaining business because of service and our ROI savings delivery. So that's a really good outcome. So that's Australia. We're going to have, it's still tough out there, but we are winning a lot of business. We've won more business in the 8 months to February than we've won in any other year in our history. And the wins keep continuing even yesterday. So we're going to have a really good 17, we think, and we're going to have a late surge in Australia, which is great because the market is very average at best. Asia, what a cracking result, hey? Up 65% off a big business. Again, want to reinforce, we always said that once Asia got around $1 billion in sales, we felt that the way we put our business acumen over a business in terms of productivity and shared services and buying power, we'd see that surge, and it's happening. That growth is primarily corporate, but also wholesale. And as we've said it all along, you know, everyone's going, oh, boo-hoo, China, it's falling apart. Our wholesale business is all to the OTAs, and the OTAs are obviously caning in that area. So why are OTAs buying content off us? Because we're so large in Northeast Asia, particularly Hong Kong and China, that everyone's buying our content because not only is it the cheapest content, but we deliver it very, very effectively through our technology. So that's the story there. It's funny because we looked at Asia, you know, we bought this thing 2.5-3 years ago, and at that point, you know, they didn't even have a sales strategy. They've now got a really sophisticated CRM. In fact, yesterday they just won a very large global headquartered company out of Asia that they led globally. So it's sort of to go from being, I guess, amateur at best to being that sophisticated to run a global tender and win it for the company is very, very satisfying for us. So Asia continues. And again, as we said, both those markets, and again, another record EBITDA. We never thought we could get EBITDA margins like that. We've never seen that in travel, which says much about our business acumen, which is really exciting. So when you come to the new jurisdictions in the US and Europe, I'm not going to say we're going to get the same margins, but that just sort of shows what happens when we get an integrated business. So if we come to the States, that's why we're spending so much time integrating. So the States, you know, really what we've done, we've taken 5 cottage businesses and we've put them together to corporatise it. So I can tell you right now we're at the end of that, and it's now game on. And when I say game on, I mean in all our drivers. Our sales pipeline is now the size of Australia's, which is really fantastic, which is about triple what it was 12 months ago. And we know in our business, once we get a sales pipeline, we know that a sales pipeline converts into wins, give or take. So that's the thing that we're really pleased about. We've integrated the business enough that now we're starting our productivity project, which we've done so successfully in Australia, and we're halfway there in Asia. You've seen that Asia EBITDA margin. That project's all about letting the grassroots in our business come up with ideas that make their life easier and to cut away or strip away process that adds no value to a customer. And that started 1 February. We're also starting to get buying power. I told the story on the road show just to put perspective on what buying power looks like. We always said it would start at $500 million, but $1 billion would be a magic mark. And with Montrose along, it's starting to happen. So, you know, we're starting to sign contracts. The contract period over there is 1 April. We're starting to get some good incremental gains. So that's good. And also, of course, now we're starting to optimise with shared services. We took $1 million worth of redundancies in the first quarter, which should play out over the year. So in that sense, we think think we've got all these levers to pull in America, which is really good for the next 6, but particularly FY17. And lastly, Europe. If you remember, we said we paid a little bit more for Europe because we knew we could plug and go that business because we've worked with them. And for us to buy a business in the first 12 months and be up 29% of the top line is quite incredible when you buy an acquisition. They're now leading global wins for us, but more importantly, as we've learned from America, we really want to invest in getting the scale right so we can get that scale up so we can start putting in the processes we're talking about. And they started their productivity project from 1 January. So you can see we've got all, so if you look out long in the business, we are certainly winning more business and market share, plus we're winning some global and regional, which we call Growth Plus. We are getting the global buying power. We are rolling out our revenue per FTE, and you've seen that success in Asia and Australia. And we're starting to get the scale we need, so it's sort of game on where we're at. Other than that, just want to quickly talk about Montrose. It's a very exciting acquisition for us. Well, in fact, it's either going to be the best acquisition we'll ever make, or it's just going to be another one. But if you read between the lines, we bought that business not only because of its LA footprint for us for corporate and especially events and entertainment. We're very strong in that globally. It's more about this. The loyalty program they do. So what they do, they essentially fulfill for big finance companies. They've got 21, 22 banks where they fulfill redemption programs. So if you're building up frequent flyer points, you want to redeem it for travel, that's us behind the scenes. For those after the AGM that saw our technology showcase, and I hope there were some in the room, it's pretty obvious that we've got a very, very strong consumer-facing technology platform that we could turn on in a heartbeat to be a consumer website if we wanted to. We believe putting their world-class back office with our front end and attacking consumer discretionary clients and financial clients could reap big rewards. Our strength is consumer-facing technology and big data, and if we can combine it together, that's the aspiration, that's the vision. We tend to execute, but time will tell. So that's why we're so excited about that one, because it could take us into a whole new stream. And if you've seen our business now, we're doing exceptionally well at corporate. We're really starting to leverage now this B2B because, again, we've got good technology to deliver that, and we've got good, in some regions, we've got very strong content. So this is sort of the third string in our bow. That's something that is actually reporting into us globally. That's what we think about it. So other than that, cash flow was good, and for those doubters or the haters out there, if you're not sure that we can't do it full year, just put second half last year together with this first half, it gives you around 100%. The reality with cash flow is that typically second half is slightly weaker than first half because we have a full year of overrides outstanding from our Australian domestic carriers only that have an annual target. So typically, at this time, second half will be probably $6 or $7 million less than first half, but we get that in the first half. So first half should be over 100%, second half under a bit under 100%, but we're getting 100% cash conversion. End of story. I don't know what more to say about that. And that's the business. We're still looking at acquisitions, more America, because we've always want to get to that billion US. We know what the scale looks like, and I mean the proof in that is when we go back to listing, we said 500 million in Australia was an important number, and look what the business has done since we've got through that. We said $1 billion in Asia was a good number for scale. Look what's happened in that business the last 12, 18 months since we've blown through that. So that's where we're looking. We've got a lot of choice in Europe as well, but the lessons we've learned from America is let's get what we've got optimised first and buy later so we can really add value to any future acquisition. So that seems to be the case right now. And, there's a few geographic holes in America still. We're not very strong in the northeast. Canada's a good opportunity as well, but, Canada's sort of a bit of carnage out there at the moment, so we're sitting back watching those profits go down so we can get a better deal later in time. So that's the way we're looking at the business. And we've said our guidance is, at the top at 68. You guys know how we work now. I mean, whether we win or lose stuff we've got nothing we know we're going to lose as of today. So if something said tomorrow, by the time it transacts out, it'll make a pretty material difference. So we're just trading on see how we go into the full year, and we want to make sure Montrose does well, the new acquisition in California, and so far so good.